Guys, they want their gold back, and this is what comes next. We just witnessed one of the most violent reversals in the commodities market in years. Gold got absolutely wrecked today. Silver got crushed, platinum down, palladium down, copper down. Every single metal is getting sold off hard. And the money isn't going into Bitcoin. It's not going into tech stocks. Tesla just reported earnings, and even though they beat on some numbers, the stock isn't an attractive buying opportunity right now, with competition heating up and revenues declining. The money is rotating into something that almost nobody is talking about. And by the end of this video, I'm going to show you exactly where the smart money is moving and the one specific stock that I think is the best way to position for this shift. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, if you're the one making the actual purchases and sells, you have to do your own diligence as well. Take your time, be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now let's get into it. Here's what just happened and why it matters. Gold dropped hard today. We're talking about a massive sell-off. After hitting record highs just days ago, gold crashed down by about 6% in only a few sessions. Silver got demolished even worse. It was up nearly 200% over the past year, and now it's down roughly 15% from its peak. Platinum down, palladium down, copper down. Every single metal across the board is red. And here's what's wild. Just a few weeks ago, everyone was talking about the metal shortage, central banks buying gold at record levels, countries wanting to bring their physical gold back from the Federal Reserve vaults in New York, Germany's economists calling for their gold to come home. There was this massive fear that the gold that countries think they have in storage might not actually be there. The whole system was supposedly breaking down. And then, boom, reversal, the fastest, most violent reversal we've seen in years. So what changed? Why did metals go from being the only thing everyone wanted to own to suddenly getting sold off hard? Let me walk you through exactly what's happening, because this is critical to understand. First, let's talk about what drove metals higher in the first place. It wasn't just demand, it was fear. Fear about the dollar, fear about inflation, fear about the government printing too much money, fear about the debt spiral that Ray Dalio keeps warning about. Central banks around the world were dumping US treasuries and buying gold. Countries were worried that if they held reserves in dollars, the US could just freeze those assets like they did with Russia. So everyone piled into gold and silver. The price went parabolic. Gold was up over 60% in a year. Silver was up almost 200%. It was an absolute mania. And what happens with manias? They end, usually violently. And that's exactly what we're seeing right now. Now, here's what people are missing. The rotation out of metals isn't happening because the problems went away. The dollar is still weak. The debt is still massive. Inflation is still a concern. So why are the metals getting crushed? Because the market is forward looking. And the market is starting to price in something different. The market is starting to realize that the next phase isn't about safe haven assets like gold. The next phase is about real economic activity, about energy, about oil. Let me explain why this matters. When gold and silver were going parabolic, everyone was betting on collapse. They were betting that the dollar would die, that the system would break, that we'd need hard assets to survive. But what's actually happening? Trump is cutting deals. He's threatening Iran, but also saying, make a deal. He's pushing for energy dominance. He's talking about drilling more oil. He's focused on economic growth, not economic collapse. And when the market shifts from pricing in collapse to pricing in growth, that changes everything. Gold doesn't benefit from growth. Gold benefits from fear. But oil benefits from growth. Economic activity requires energy. You can't run data centers without power. You can't manufacture goods without energy. You can't move products without fuel. Oil is the lifeblood of a growing economy. The smart money is rotating. They're taking profits on metals after these massive runs, and they're moving into energy, specifically large cap oil companies. And here's the thing. Most people haven't figured this out yet. If you go on CNBC right now, they're still talking about buying gold. The talking heads are still saying gold is going to skyrocket. They're still pushing the fear narrative. But if you actually look at the gold chart, it just got wrecked. The technical damage is severe. We saw a huge gap up followed by an immediate reversal. That's called a failed breakout. That's distribution. That's smart money selling to dumb money. And the people still watching CNBC talking about buying gold are the ones getting left holding the bag. Now, let me also mention Bitcoin because this is important. Bitcoin is not catching a bid. You would think that if metals are selling off, maybe the money would rotate into Bitcoin, digital gold, right? But no, Bitcoin is flat. It's not moving. Why? Because Bitcoin doesn't benefit from economic growth either. Bitcoin, like gold, benefits from fear and speculation. When people are scared about the system, they buy Bitcoin. When people think the economy is going to grow, they don't need Bitcoin. So we're seeing metals down, Bitcoin flat, and oil starting to catch a bid. This is a major rotation happening in real time, and most investors are completely missing it. Oil's been stuck in a range for months. It's been boring. Everyone forgot about it because metals were the exciting trade. But oil is starting to wake up. Crude oil closed up over 1.5% today. That might not sound like much, but it's the direction that matters. While everything else is getting sold, oil is holding up, and that's telling you something. Trump came out today and said a massive armada is heading towards Iran. He said, time is running out. Make a deal. The next attack will be far worse. Now, whether or not anything actually happens with Iran, the point is that geopolitical tensions around oil are increasing, and when there's uncertainty around oil supply, prices go up. It's that simple. But here's the deeper reason oil is the trade. Energy security. For the last few years, everyone was focused on going green. Wind, solar, electric vehicles. And those things are fine, but the reality is we still need massive amounts of oil and natural gas. Data centers can't run on solar panels. You need reliable 24/7 power. That comes from oil and natural gas. The AI build-out that we talked about with copper and data centers, that requires energy, tons of it. And the only way to power that growth is with oil. So as the market shifts from pricing in collapse to pricing in growth, oil becomes the critical asset, not gold, oil. Now let's talk about the supply situation because this is important. OPEC has been cutting production. They've been trying to keep prices stable, but demand is increasing. China is buying more oil. India is buying more oil. The US is producing a lot, but we're also using a lot. The global supply and demand picture for oil is actually pretty tight. It's not like there's this huge surplus sitting around. And unlike gold, where central banks can just keep stacking it in volts, oil gets consumed, it gets burned, it gets used up. So when demand increases, prices have to go higher to incentivize more production. And right now, demand is increasing. Let me also point out what's happening with the metal miners. The stocks that were flying high just days ago are now getting crushed. Gold miners getting sold, silver miners are getting hammered. These stocks were up huge, and now everyone who was late to the trade is getting stopped out. That's how these rotations work. The last ones in are always the first ones out, and it's brutal. But energy stocks, they're holding up. They're not collapsing like the metal miners. And that divergence is telling you where the next move is. When one sector is breaking down and another sector is holding up, that's your signal. The money is rotating. Now let me talk about the bigger macro picture because this all ties together. The Federal Reserve had their meeting this week. They kept rates the same. No surprise there. They said inflation is still somewhat elevated, but here's what matters. The market is starting to believe that the worst of the inflation scare is over. That doesn't mean inflation is gone, it just means it's not accelerating anymore. And when inflation is stable but not accelerating, that's actually good for economic growth. It means companies can plan, they can invest, they can build things. And building things requires energy. So the macro backdrop is shifting from fear of runaway inflation to optimism about economic growth. And that's why oil is the trade, not gold. There's also the government spending angle. Trump is pushing for massive infrastructure spending. Defense spending, energy projects, all of that requires oil. The government isn't going to suddenly stop using oil just because some people want to go green. The real world runs on oil, and it's going to keep running on oil for a very long time. Now, let me explain something that most people don't understand about how these metals got so high in the first place. Because if you understand how we got here, you'll understand why the reverse is so violent. Most of the gold and silver that trades isn't actually physical metal. It's contracts, futures contracts, paper claims on metal that might exist somewhere in a vault or might not. The futures market works like this. A mining company knows they're going to produce a certain amount of gold over the next year, so they sell futures contracts to lock in the price today. That way, they have certainty about their revenue. And buyers purchase those contracts because they want exposure to gold without having to store physical bars. It's all paper. And it works fine until everyone wants physical delivery at the same time. That's what people were worried about a few weeks ago. Countries like Germany saying, we want our actual gold back from the New York Fed vaults. Not paper claims, actual bars. And if everyone starts demanding physical delivery, the system can break because there's way more paper gold than physical gold. It's similar to a bank run. If everyone tries to withdraw their money at the same time, the bank doesn't have it all sitting there. This is called backwardation in the futures market. It's when the spot price, the price for physical delivery right now, is higher than the futures price. That should never happen. Futures should always be higher because they include storage costs and time value. But when everyone wants physical immediately, spot goes higher than futures. That's a sign of serious stress in the market. We saw hints of backwardation in gold and silver over the past weeks, and today the reversal. That's what's driving the mania. People were generally worried that the physical supply wasn't there. The vaults at the New York Fed weren't empty. When Germany asked about their gold, the answer was yes, it's here, you can have it. The crisis that everyone feared didn't materialize. And when the crisis doesn't happen, all that fear buying reverses immediately. That's why the sell-off is so violent. All the people who bought gold at record highs because they thought the system was collapsing are now realizing the system isn't collapsing, at least not right now. So they're selling. And everyone who was late to the trade is getting stopped out. and you get this cascading sell-off where everyone is trying to exit at the same time. This is textbook market behavior. Fear drives prices to unsustainable levels, then reality sets in. Then the reversal is brutal. We've seen this pattern over and over throughout history. The dot-com bubble, the housing bubble, the crypto bubble, and now the metals bubble. The pattern is always the same. Let me also talk about what's happening with silver specifically, because silver got hit even harder than gold. Silver peaked at nearly 200% gains in less than a year, and the move from earlier levels to that peak happened in just a few weeks. That's not a healthy bull market. That's a blow-off top. Silver has this dual nature. It's both a monetary metal like gold and an industrial metal like copper. So it benefits from both fear and economic growth. But when it goes parabolic like it did, that's purely speculation. That's not industrial demand. That's not jewelry demand. That's people buying because the price is going up and they don't want to miss out. And what happens when the speculative mania ends? All those late buyers get crushed. The people who bought silver at the top thinking it was going to skyrocket are now sitting on big losses. And a lot of them are selling, creating more downward pressure. This is why you never chase parabolic moves. You either buy early or you wait for the next setup. Now, let me connect this back to oil because this is the key insight. When fear drives markets, gold goes up. When growth drives markets, oil goes up. And what we're seeing right now is a shift from fear to growth. The market was pricing in collapse, dollar collapse, system collapse, gold and silver going to the moon because everything else was going to zero. But that's not happening. Trump is cutting deals. He's focused on making the economy grow. He's talking about energy independence, about drilling more oil, about building infrastructure. None of that requires gold. All of it requires oil. So the market is repricing from collapse to growth. And in that environment, oil is the asset you want to own. Let me give you another angle on this. The whole metals mania was built on the idea that the dollar was dying, that central banks would stop using dollars, that we'd move to a gold-backed currency. And there's some truth to that long term. The dollar is losing reserve status. Central banks are buying gold. The BRICS countries are talking about a new currency, but that's a 10-year story, not a 10-week story. It's not happening overnight. So betting on immediate dollar collapse by buying gold at record highs is a bad trade. You're paying for a crisis that might not happen for years. And in the meantime, you're missing the actual opportunities in front of you. Oil is an actual opportunity right now, not 10 years from now, right now. Demand is increasing, supply is constrained, OPEC is cutting production, the US is producing a lot but also consuming a lot, China is buying more, India is buying more, and unlike gold sitting in a vault doing nothing, oil gets used, it gets consumed, it has to be replaced. That creates ongoing demand that doesn't exist with gold. Let me also talk about the energy transition narrative because this is important. For the past few years, everyone was saying oil is dead. Electric vehicles are taking over. Solar and wind are replacing fossil fuels. Oil companies are dinosaurs. That narrative pushed a lot of investors out of the sector, and that's why energy stocks have been so cheap. But the reality is very different from the narrative. Yes, we're adding solar and wind capacity. Yes, electric vehicles are growing, but the world still needs massive amounts of oil. Data centers can't run on solar panels when the sun goes down. You need baseload power. That comes from natural gas and oil. The AI revolution that everyone's excited about requires energy, lots of it, and most of that energy comes from fossil fuels. So the narrative was wrong. Oil isn't dead. Oil is more important than ever. And now the market is starting to realize that. The stocks have been beaten down for years based on a false narrative. And now they're starting to catch a bid as reality sets in. This is exactly the kind of setup you want to find. a sector that's been hated and ignored, but is actually critical to the economy. Now, let me talk about natural gas more specifically because this ties into everything. Natural gas is what powers a lot of the data centers we keep talking about. It's cleaner than coal. It's more reliable than solar or wind. And the US has massive natural gas reserves. We're the largest producer in the world. And major energy companies produce huge amounts of natural gas. Natural gas prices have been volatile over the past year. They spiked during the winter when demand for heating was high. Then they came back down. But the longer term trend is higher because of data center demand. Every new AI data center that gets built needs power, and a lot of that power comes from natural gas. This is another reason why energy exposure is attractive. You're not just getting oil, you're getting natural gas. You're getting exposure to the entire energy complex, and energy is what makes the economy run. You can't have economic growth without energy. It's impossible. Now let's also address the geopolitical angle because this is driving some of the moves in oil. Trump came out today talking about Iran, a massive armada heading towards them. Time is running out. Make a deal. Now, whether or not anything actually happens, this kind of rhetoric creates uncertainty, and uncertainty around Middle East oil supply always pushes prices higher. Iran produces about 3 million barrels of oil per day. That's not huge in the global context, but it's meaningful. And if there's any disruption to Iranian oil, whether from sanctions or military action, that supply comes off the market and prices go up. So the geopolitical premium is coming back into oil, and that's been absent for months. There's also the Russia-Ukraine situation, which affects European energy supplies, and the China-Taiwan tensions, which affect global trade routes. All of these geopolitical risks support higher oil prices because oil is a globally traded commodity, and any disruption anywhere affects prices everywhere. Compare that to gold. Gold prices went up on geopolitical fear. But gold doesn't get consumed by geopolitical events. It just sits there. So once the immediate fear passes, gold prices come back down. Oil is different. If supply actually gets disrupted, prices stay high until the supply comes back. It's a physical constraint, not just a sentiment issue. Now, let me address the risk because I want you to understand what could go wrong with the oil thesis. Risk number one, what if oil prices don't go higher? What if OPEC increases production and floods the market? That's possible, but right now, OPEC is being disciplined. They're cutting supply, not increasing it, and demand is strong, so the balance favors higher prices. Risk number two, what if the economy actually slows down? What if we go into a recession? Well, in that case, a demand for oil would drop and prices would fall. But if that happens, gold would probably rally again. So you have to decide what you think is more likely, economic growth or economic collapse. I think growth is more likely, which is why I prefer oil over gold right now. Risk number three, what if metals reverse and start going back up? That's always possible, but the technical damage is done. The failed breakout, the massive volume on the sell-off. These are not signs of a healthy bull market. These are signs of a top. So even if metals bounce, I don't think they're going back to new highs anytime soon. All right, now let me get to the specific stock that I think is the best way to play this rotation. The company is Chevron, ticker symbol CVX. This is one of the largest oil companies in the world. They produce oil and natural gas. They refine it. They sell it. They're a fully integrated energy company, and they're exactly the type of large cap, stable, cash flowing business that smart money rotates into when they want exposure to oil. Here's why Chevron specifically. First, size and stability. Chevron is huge. They have operations all over the world. They're not some speculative small cap that could blow up. They're a blue chip energy company. When institutions want oil exposure, they buy Chevron. When sovereign wealth funds want oil exposure, they buy Chevron. It's one of the safest ways to play the sector. Second, cash flow and dividends. Chevron generates a massive amounts of cash, and they pay it out to shareholders in the form of dividends. The current dividend yield is over 4%. That's real income. That's not speculation. You get paid while you wait for oil prices to go higher, and if oil prices do go higher, Chevron's profits explode because their costs are relatively fixed. Third, valuation. After months of being boring and ignored, Chevron is actually cheap relative to its historical valuation. The stock hasn't participated in the market rally. It's been dead money while everything else went up. But that's exactly when you want to buy. You don't want to buy after something already rallied 50%. You want to buy when it's out of favor and about to catch a bid. Fourth, technical setup. Chevron is holding key support levels. It's not breaking down like the metal stocks. It's consolidating, building a base, and when oil starts its next leg higher, Chevron is going to break out. The risk reward right here is excellent. You're not chasing, you're buying before the major move. Now, let me compare this to other options in the sector. You could buy an oil ETF, something like XLE, which holds a basket of energy stocks. That gives you diversification, but it also means you're getting exposure to companies you might not want. I prefer concentrated bets on the best companies in the sector. And Chevron is the best. You could also buy smaller oil companies, companies that have more leverage to oil prices, and those can work, but they're riskier. They have more debt. They're more volatile. For most people, Chevron is the right balance of upside potential and downside protection. Let me also mention ExxonMobil, ticker XOM. That's the other giant in the sector. And Exxon is also a great company. The difference is that Chevron has slightly better valuation right now and slightly better technical setup. But honestly, you can't go wrong with either. If you want to split your position between Chevron and Exxon, that's a totally reasonable approach. Now let's talk about the timeline because this matters. I don't think this is a 1-week trade. I think this is a position you hold for months. Oil is in the early stages of its next leg higher. Crude is starting to move up, and we could see a significant percentage gain over the coming months if tensions with Iran escalate or if demand continues to rise. Chevron stock could easily outperform the move in oil because of its leverage and integrated business model. So this isn't a quick flip. This is a core position, something you build into and hold as the rotation plays out. And the beautiful thing is that you're getting paid a dividend while you wait. So even if oil takes time to move, you're collecting income. Let me also talk about what's happening with the refiners because this is related. Companies that refine crude oil into gasoline and diesel are also interesting right now. Valero, Marathon Petroleum, Phillips 66, these companies benefit when refining margins are strong, and refining margins have been improving. So if you want even more specific exposure to energy, the refiners are worth looking at. But for most people, Chevron is simpler and safer. Now, let me bring this back to the bigger picture. We're in the middle of a massive capital rotation. For months, everyone was piling into metals. Gold, silver, platinum, copper. The trade was crowded. Everyone was positioned the same way. And what happens when everyone is positioned the same way? The market reverses. It has to. That's how markets work. So the metals trade is over, at least for now. Maybe it comes back in 6 months or a year, but right now, the momentum is gone. The charts are broken. The narrative is shifting, and the smart money is moving into the next opportunity, which is oil. And here's the key. Oil is not crowded yet. Most investors are still focused on tech stocks or metals or Bitcoin. Energy's been boring for months. Nobody's talking about it, but that's exactly when you want to get in. You want to buy what's hated and ignored before everyone else figures it out. By the time CNBC starts talking about the oil shortage and showing charts of crude breaking out to new highs, it'll be too late. The easy money will be gone. You want to position now while it's still early, while Chevron is consolidating and cheap and nobody cares. Let me also address the inflation angle because this ties in. A lot of people think higher oil prices mean higher inflation, which means the Fed has to raise rates, which is bad for the economy. But that's not quite right. Yes, higher oil prices contribute to inflation, but they also signal economic growth. And right now, the market cares more about growth than inflation. The Fed already said they're keeping rates steady. They're not cutting yet, but they're also not hiking. So we're in a stable rate environment. And in that environment, higher oil prices are actually bullish because they confirm that economic activity is increasing. It's a sign of strength, not weakness. Now, let me talk about the alternative scenario because I want you to think about both sides. What if I'm wrong? What if metals reverse and go back up? What if oil stays flat or goes down? Well, in that case, you'd want to be in gold and silver, not Chevron. But here's why I don't think that's likely. The technical damage in metals is severe. We saw climactic volume on the sell-off. We saw failed breakouts. These are classic signs of a mania ending. And manias don't come back quickly. They need time to reset, to build a base, to wash out the weak hands. So even if metals do bounce from here, I don't think it's the start of a new leg higher. I think it's a dead cat bounce, a relief rally that fails, and then the downtrend continues. Meanwhile, oil is just starting its move. It's not parabolic. It's not crowded. It's not on CNBC every day. It's boring. And boring is exactly what you want before a big move. Let me give you some historical context because this has happened before. In the 1970s, we had massive inflation. Oil prices went through the roof. Gold went up a lot too, but eventually oil was the better trade because it was tied to real economic activity. In the 2000s, we had a huge commodities bull market. Oil went to very high levels. Gold went up too, but oil was the bigger winner. The point is that when you have real economic growth happening, oil outperforms gold. And right now, the market is starting to price in growth, not collapse. So oil is the trade. Let me also talk about what Chevron specifically is doing on the operational side because this matters. They've been investing in new projects. They're expanding production capacity. They're improving efficiency. And they're doing all of this while maintaining a strong balance sheet. They're not over leveraged like some smaller energy companies. They have the financial strength to weather any short-term volatility in oil prices. Chevron also has exposure to liquefied natural gas or LNG. This is huge. Europe needs LNG after cutting off Russian pipeline gas. Asia needs LNG for power generation, and the US is one of the largest LNG exports in the world. Chevron has multiple LNG projects that are coming online over the next few years. This is going to be a major growth driver for the company. So when you buy Chevron, you're getting oil exposure, natural gas exposure, LNG exposure, refining exposure. It's the full package. And management has been very disciplined about capital allocation. They're not wasting money on bad projects. They're focused on returning cash to shareholders through dividends and buybacks. This is the kind of company you want to own in an inflationary environment. They have pricing power. When oil prices go up, they can charge more. When inflation hits, their revenues go up faster than their costs. This is why energy stocks historically do well during inflationary periods. They're a natural hedge. Now, let me also mention the political angle because this affects energy companies. Trump is very pro-energy. He wants to drill more. He wants energy independence. He's rolling back regulations that made it harder to develop oil and gas projects. This is a tailwind for companies like Chevron. The regulatory environment is improving, not getting worse. Compare that to the last administration, which was much more hostile to fossil fuels. Chevron and other energy companies were under constant pressure. Permitting was difficult. Environmental reviews took forever. The political winds were against them, but that's changed. Now you have an administration that views energy production as a national security priority. That's a big deal. Let me wrap this all up because I want to make sure the main points are clear. Metals just got crushed. Gold, silver, platinum, palladium, copper, all down hard. The mania is over. The charts are broken. The people still talking about buying gold on CNBC are the ones who are going to lose money. Bitcoin is not catching a bid. It's flat. The money isn't rotating into crypto. It's rotating into oil. Large cap energy companies like Chevron are the new safe haven. They're stable, cash flowing businesses that benefit from economic growth. And Chevron is the best way to play this rotation. The stock is cheap. It's consolidating. It pays a dividend. And when oil starts its next leg higher, Chevron is going to explode. The risk reward right here is excellent. You're not chasing. You're positioning before the move. So if you're holding metals, I would seriously consider taking profits. If you're on the sidelines, I would be looking at Chevron. And if you're still listening to the talking heads on CNBC telling you to buy gold, I would turn off the TV and look at the actual charts because the charts are telling you a very different story. The opportunity is now, the rotation is happening, and the people who position correctly are going to make serious money over the next few months. Don't wait until oil is already rallied. Position now while the setup is still fresh. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, head over to stockscommunity.com. Try my Discord, the Stocks Community, for just $25 for 7 days. I break down rotations like this in real time every single day. Plus, if you want the full transcript of this video and future videos, sign up at free.stockscommunity.com. The link is in the description below. So what do you think about this rotation? Do you think metals are done? Do you think oil is the next big move? Let me know in the comments. I love hearing from you. But that caps off today's video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it. Because the window is closing. The opportunity is now. And the people who understand what's happening are going to make a lot of money in 2026.